Welcome to LM1, what you need to know. If you've been to one of these sessions before, you're probably well versed in that it moves very quickly because we cover the whole book in an hour. LM1, pretty chunky module, really setting the scene for all of your CII studies. I know you will probably find yourself coming back to this module over time. And referring back to it across most of your studies. So I'll try to do this whole module in an hour. Sometimes I do tend to run a little bit over. So if I do run a little bit over, if you can stay with me, that'd be brilliant. If not, I am recording the session. I always record these sessions. Even if, and I know that some people can't make it sometimes on Friday afternoons, so we always record them and put them on our YouTube channel, so they're always there every week whether people come or not. So we want to make sure we get that content out to you. So if you can't catch the end of the session, then please feel free to go and watch that on YouTube. Typically, I think we'll probably get this uploaded to YouTube probably on Monday. So if you do want to rewatch it back, that's when you'll be able to see that. If you are on one of our courses, you will have access to this session anyway. There is another recording of it in the additional materials section. I'm going to get stuck right in because we've got a lot of stuff to go through. So of course we'll start at chapter 1 and we'll start with the concept of risk. So I'll just let you know as well, my chat will be open if you want to ask any questions. I'll also stick around at the end if you want to talk to me about anything exam related or about the LM1. So I will be here. So the term risk, we use this word quite interchangeably in the market. You might hear people saying, what's the risk? What's on risk? Are we on risk? Things like that. So it's used many different ways. But there is, of course, a definition, which is the possibility of something unfortunate happening, any doubt concerning how something will turn out, unpredictability, the possibility of loss, and also the chance that there might be a gain, which, of course, we can't ensure that, and we will look at that in a moment, but that is the definition of risk. And insurance is known as a risk transfer mechanism. And what this means is that you pay a premium and transfer the risk to somebody else, to an insurer. Because typically we don't want to hold those risks ourselves. That's why we purchase insurance. So what insurers do is they take all those premiums of all of the money and collect those into something called the common pool. I like to think like a pool full of money, and that's all of our premiums. And it's an insurer's job to make sure that all of the premiums coming into there are fair and they're accurate for the risk that that person's bringing, and just to make sure that that pool stays topped up. Okay. And then out of that pool, we'll pay for any claims that happen. And we all have different attitudes to risk. Some people we call risk seekers, happily throw themselves out of a plane. I am not one of those people. I am fairly risk averse, probably because I've worked in insurance for so long. And insurers have their own risk appetite. So they have their own views on risk as well. So the insurers that you work for will probably have a list of risks that they really, really like to write, and then maybe ones that they don't like so much either, that you might just go, no, we don't want to touch that. Or you might charge a really high premium because it's not something that you like to write and it's quite risky in your opinion. So this chapter also looks at risk management, and this is a key focus across many companies. There's 3 aspects that make up the risk management process, which is important to know for your exam. So the first is the identification of the risks, and then comes the analysis of those risks. And then finally is where we put controls in place to try and minimize those risks or even get rid of them entirely. So we can control or eliminate risks through 2 different controls. So the first is physical. So this could be through maybe fitting an alarm or putting locks on your door, something that you can physically do. And the second way is through financial controls. And this is where we're purchasing insurance, just to ensure we've got that safety net and we've got that backup just in case something does go wrong. So you've got physical measures and financial measures in order to manage those risks. So as an insurer, there's two bodies that insurers can use to aid with their risk management controls, which you should probably familiarise yourself with for the exam. So we've got the Building Research Establishment, BRE. They look at the built environment. They offer training and guidance on building materials and construction. And then we've got the FPA, the Fire Protection Association. They are the UK's national fire safety organisation. And they give advice and training on fire control. Got my words mixed up then. So going back to risk, we've got three main components of risk. Firstly, we've got that uncertainty. So we don't know what's going to happen, and we don't know when it's going to happen, and we don't even know if it is going to happen, you know. And then secondly, we look at the level of risk. So what we're going to look at next is then, if it does happen, how often does it happen? And when it does happen, how bad is it? This is called the frequency and the severity. Okay. So a few months ago, I parked my car in Aldi car park. Okay. And when I walked out of the supermarket, I could see it straight away that there was a big dint in the side of my car. And it was obvious that someone's trolley had just flew across the car park and went into my car. So if we think about this type of incident that happens, it's probably very frequent. You know, it happens all the time. People's wing mirrors get dinged, trolleys go into the car. It's high frequency, but it's actually very low severity. It's not been fixed. You know, sometimes it's not worth it. I don't want to pay my excess. It'll probably just stay there. I can see it, but no one else can notice it. Doesn't really matter. So it's high frequency, but low severity. It's not very severe. Okay. But then on the other side of the scale, if we think about another incident, say like a plane crash, thankfully these events don't happen very often. But when they do happen, they are very severe. They cause a lot of damage to the aircraft, to passengers. So this is low frequency, but high severity. So this is how underwriters can look at risks and decide, you know, how they're going to rate them, look at past events and data to figure out what the frequency and severity is. We can also have high frequency and high severity as well. So if we think about hurricanes, you know, natural catastrophes, if it's in a specific place, depending on where it is, it could be high frequency, so it happens quite a lot, and when it does happen, it's really, really bad. And as a market, you know, we can look at things like Cresta to see when these things are going to happen and really prepare ourselves for these at certain times of the year. You know, we know it's going to come in, we know it's going to be high frequency, we know it's going to be high severity. And then finally, we've got perils and hazards. So a peril is the primary cause of a loss. So this is the fire, the flood, the theft. And what a hazard does, a hazard determines how the peril develops and directly influences the operation of it. Okay, so hazards can be good or bad, good or poor, and they can be split into physical hazards. So again, tangible things like the construction of a property. And then we've also got moral hazards as well, and these relate to the characteristics of a person and the behaviour of the insured. Are they dishonest? Are they a criminal? All of these things. And all of this is going to be considered by an underwriter when we're looking at a risk and deciding if we want to write it, and if we do, what terms are we going to put it on, what premium are we going to charge. Okay.